How do you make $230 billion disappear? Let's put that in perspective. It's more than the entire GDP of Greece, Qatar, or Hungary. It's a number so huge it almost doesn't feel real. But between 2007 and 2015, this astronomical sum of money was very real, and it all flowed through a tiny, overlooked branch of one of Europe's most respected banks. This isn't a heist movie. This is the story of Danske Bank, Denmark's largest lender, and how its Estonian branch became a laundromat for a flood of dirty money from Russia and former Soviet states. This didn't happen in the dead of night. It happened in plain sight. It was made possible by an army of anonymous shell companies, a corporate culture of looking the other way, and a massive, devastating loophole that bank executives chose to ignore time and time again. This is the story of a scandal that shook European finance to its core. A story about how a single office in Tallinn, Estonia, became the heart of what might be the biggest money laundering operation in history. And it all started with a deal that seemed way too good to be true. To get how this happened, you have to go back to 2007. Danske Bank was in expansion mode. As a big player in the Nordics, it bought Finland's Sempo Bank, and along with it, inherited its branches in the Baltic states, including that little office in Tallinn, Estonia. On the surface, just a standard corporate buyout, but buried in that Estonian branch was a ticking time bomb, the non-resident portfolio. So what was this non-resident portfolio? It was basically a special unit for clients who didn't live in Estonia. After the fall of the Soviet Union, Estonia became a key gateway for money moving from Russia to the West. For wealthy Russians and others from former Soviet countries, an account in an EU-based bank was a golden ticket. It gave them stability, a dose of legitimacy, and access to the global financial system, letting them move US dollars wherever they wanted. The Danske Bank branch in Estonia didn't just offer these services, it actively chased this high-risk business. And for a while, it was unbelievably profitable. By 2011, the tiny Estonian branches, making up less than 1% of the bank's total assets, was generating almost 11% of the entire bank's profits. It was a cash cow, and its performance was celebrated. In board meetings, it's been reported that directors were more interested in the spectacular earnings than asking where all that money was coming from. But those profits were hiding a dark reality. These weren't your average customers. A huge chunk of this portfolio was made up of shadowy shell companies, many registered in secrecy havens like the United Kingdom, Cyprus, or the British Virgin Islands. These were companies that only existed on paper, designed for one thing: to hide who really owned the money. This business model was the loophole. The non-resident portfolio was like a secret bank within a bank, running on a different set of rules, or, more accurately, a shocking lack of them. The compliance systems were a joke. Know Your Customer, or KYC rules, a bank's most basic duty to check who its clients are, were practically ignored for these accounts. It was the perfect environment for dirty money to pour in, get cleaned up, and then get sent back out into the world. It was a backdoor to the Western financial system, and Danske Bank Estonia was holding the keys. A scandal this big doesn't just happen. It takes years of neglect and systematic refusal to see what's right in front of you. The red flags at Danske Bank weren't just waving, they were a hurricane of warnings, and a shocking number came from official sources. The alarm started ringing almost as soon as Danske took over, as early as 2007. Russia's own central bank sent a letter to Danske's headquarters in Copenhagen. It warned that the Estonian branch was being used for transactions of criminal origin in its purest form, including tax evasion and possibly terrorist financing. Think about that for a second. A Russian regulator was telling a major European bank that its branch was a hub for crime. The warning was noted, but nothing changed. Soon after, Estonian regulators voiced their own serious concerns, flagging the dangerously high-risk activities at the branch. But perhaps the most damning failure was internal. A critical decision was made not to move the Estonian branch onto Danske Bank's main IT and risk monitoring systems. The branch was allowed to keep using its own outdated tech. To make matters worse, most of the client documents were in Russian or Estonian, making it nearly impossible for anyone in Copenhagen to do any real oversight. This created a compliance black hole. The very systems that should have automatically flagged suspicious transactions were completely blind to what was going on in Estonia. It was a recipe for disaster, leaving the branch to operate like a rogue state inside the bank. Even when internal audits did find problems, the response from senior management was lukewarm at best. In 2010, Thomas Borgen, the executive in charge of international operations, including Estonia, waved off concerns about Russian transactions, saying he hadn't come across anything that could give rise to concern. By 2012, non-resident accounts from Russia alone made up 35% of the branch's profits. The money was just too good to question. The bank knew it had high-risk customers, but for years it gambled that its procedures were good enough. They were catastrophically wrong. The bank wasn't just missing red flags, it was actively choosing to ignore them. So, how do you wash $230 billion? The methods weren't revolutionary, but the scale was off the charts. The whole system relied on a simple, repeatable process, done thousands and thousands of times. It all started with shell companies. These entities, often set up as UK-registered limited liability partnerships, or LLPs, were the key tool. LLPs gave a nice gloss of British legitimacy while letting the real owners stay completely anonymous. Paperwork filed in the UK could just list other anonymous companies in places like Belize or the Seychelles as the owners, creating a maze of secrecy. These shell companies would open an account in the non-resident portfolio at Danske Bank, Estonia. Since the bank's Know Your Customer checks were so weak, these accounts were opened with almost no questions asked. Once the account was open, the wash cycle began. Huge sums of money, mostly from Russian sources, were wired into the shell company's account. These were often disguised as payments for goods or services that didn't exist. The second that money landed in the Estonian branch, it was officially inside the European Union's financial system, gaining a stamp of legitimacy. The final step was moving the money out. The shell company would send payments to other companies all over the world, often to major global banks in New York, London, or Frankfurt. Because the money was now coming from a supposedly reputable Danish bank, the international correspondent banks that process global payments were less likely to get suspicious. In fact, Danske Bank actively misled U.S. banks about its broken anti-money laundering systems to keep this critical pipeline open. Over 8 years, an estimated $160 billion was funneled this way through U.S. banks alone. This cycle was repeated over and over. An investigation later found around 9.5 million payments connected to this portfolio. The system was an industrial-scale laundromat. Dirty money went in, it got tumbled through a series of shell companies, and a complicit bank and it came out clean on the other side. Some of these schemes were later linked to the family of Vladimir Putin and the Russian intelligence service, the FSB. This wasn't just about dodging taxes. This was about sanitizing the proceeds of crime on a global scale. By 2013, the Estonian money machine was firing on all cylinders, but one man, an insider, refused to look the other way. His name was Howard Wilkinson, a British executive who was head of Danske's trading unit in the Baltics. From his vantage point, he started noticing things that didn't add up. He found one company that had filed paperwork in the UK claiming it was dormant and doing no business, yet Wilkinson could see millions of dollars flowing through its Danske account. When he dug deeper, he realized the problem was systemic. In late 2013, Howard Wilkinson did what you're supposed to do. He wrote a series of explosive reports to the executive board in Copenhagen. He wasn't just flagging suspicious activity, he was telling the bank that one of the suspicious networks apparently included the Putin family and the FSB. The response he got was classic corporate stonewalling. Management assured him the situation would be handled and launched an internal audit, but the audit's findings were watered down, under pressure from management, and the report was buried. The atmosphere at the branch turned hostile. Wilkinson was ostracized by colleagues. He resigned in April 2014, just a few months after filing his first report, citing ethical reasons. Before leaving, he warned the bank that if they didn't report what he'd found to the authorities, he was prepared to do it himself. For years, his warnings were ignored. Danske Bank even tried to silence him with a non-disclosure agreement. But the truth couldn't stay buried forever. Wilkinson was the man who lit the fuse, even if it would take a few more years for the bomb to go off. Howard Wilkinson's story is a stark reminder that sometimes the only thing standing between a corrupt system and the truth is the courage of one person. It was almost why deep dives like this are so important for holding power to account. If you believe in this kind of investigative storytelling, take a moment to subscribe and hit the notification bell. It helps us continue to bring these complex stories to light. And as we head into the fallout, think about this. What does it say about our financial system when one person's conscience is a better deterrent than billions spent on compliance? After Howard Wilkinson resigned in 2014, the money kept flowing. Danske Bank finally shut down the most problematic parts of the non-resident portfolio in 2015. But it was too little, too late. The fuse Wilkinson had lit finally hit the powder keg in 2017, when the Danish newspaper Berlingske, in contact with Wilkinson, began publishing a series of articles that blew the scandal wide open. The scale of the transactions, $200 billion, or about $230 billion, was staggering. The fallout was swift and brutal. Danske Bank's CEO Thomas Borgen, the same executive who dismissed early concerns, was forced to resign in September 2018. He and 9 other former executives faced preliminary criminal charges. But after a lengthy investigation, the charges against Borgen and other senior managers were dropped in 2022 due to insufficient evidence. The bank's stock price was cut in half, wiping out billions in value. Estonian regulators ordered Danske Bank to shut down its Estonian branch entirely in 2019, a process that was completed the following year. 10 former employees from that branch were arrested. In a tragic turn, Ivar Rihi, who ran the Estonian branch during the scandal and was a key witness, was found dead in 2019 in what was reported as a suicide. But the biggest blow came from the United States. Because so much dirty money had passed through the U.S. financial system, the Department of Justice launched its own investigation. In December 2022, Danske Bank pleaded guilty to conspiracy to commit bank fraud. The bank admitted it had defrauded U.S. banks by lying about its weak anti-money laundering controls. The penalty was massive. Danske Bank agreed to a total settlement of over $2 billion in fines and forfeitures to U.S. and Danish authorities. It was one of the largest penalties ever for this kind of violation. As part of its sentence, the bank was placed on probation for 3 years, forced to overhaul its compliance systems under the eye of an independent monitor. The Danske Bank scandal was never about a single loophole. It was a story of systematic failure, a corporate culture that put profits above ethics, regulators who failed to act, and a global financial system full of dark corners for criminals to hide their money. Danske Bank's leaders claimed for years they thought the risks were being managed, but the evidence tells a story of willful blindness. They skimped on basic compliance, ignored direct warnings, and tried to silence the person who told them the truth. The scandal wasn't an accident. It was the inevitable result of deliberate choices. In the aftermath, Europe was forced to confront the holes in its defenses. The Danish parliament increased penalties for money laundering 8-fold, making them some of the toughest in Europe. But the fundamental problem remains. The challenge, for all of us, is to find the right balance. How do we build a financial system secure enough to stop the flow of dirty money, but open enough to power the global economy? The Danske Bank case proves that rules on paper mean nothing without a culture of accountability to back them up. The real loophole wasn't in any law book. It was in the minds of the people who decided that $230 billion in suspicious cash was a risk worth taking. And that leaves us with one final, troubling question. How many other back doors are still open?